It so happens that most of the reviews on my channel are dedicated either to the S&P 500 index or to Bitcoin. Basically, these are the main vectors, either for the crypto market if we're talking about Bitcoin, or for the stock market if we're talking about the S&P 500 index. So it's time to bring some variety to the reviews. But I'll say right away that the warning not to buy anything on the stock market, at least according to the S&P 500 index, was quite relevant. Why? Because in recent days this week, the index has been declining rather dynamically, and we'll see this using Tesla as an example, which we'll be looking at today. I decided to try out a new microphone. I've had it for quite a while, but maybe it won't cover half the screen, and let's see what the sound quality will be like. Let me know in the comments. And now we move on to the chart, and here we have the daily chart of Tesla's stock, and here the markings from one of the previous reviews have remained. I didn't save or delete them, so well, something was there and it stayed. Notice that I marked two important support levels. These are $379 and $362. And I marked this zone with a yellow rectangle a long time ago, back when a clear and distinctly pronounced divergence was formed at this spot on the daily candles. Because look, at that moment we updated the all-time high. Well, not the all-time, but the local high. The all-time high was probably here, but still. So we updated the high, but the RSI high was significantly lower. After that, we had a bearish engulfing pattern on the daily candles, and the price started to go down. It didn't reach the target zone, stopped near the 100-day moving average, and then moved toward a new all-time high. At that point, the RSI no longer rose above 70 and then dropped sharply, breaking through all the levels, including the 50-day, 100-day, the orange 200-day, and the blue 300-day moving averages. Pay attention to what happened next. We entered the oversold zone on the RSI at the 30 level. We dropped below all the moving averages and below this key support zone. It seemed like that was it, the market was crashing down. But no, it started testing the moving averages again. The first time it broke through, it set a local high. The second time it broke through, it set a lower high. The third time it dropped below all the moving averages and ended up above them again, but once more showed a lower high. This indicates that somewhere in this zone there were sellers who couldn't wait for a higher price and used every attempt at growth as an opportunity to offload their shares. How did this end? It ended with yet another return to this support zone, consolidation below all the moving averages, and a significant move lower. Notice that the RSI is in the strong oversold zone, which means that opening short positions here is definitely not advisable. But this does not mean that the decline is necessarily over. And in order to figure out where it might end, we need to switch to a higher time frame, to weekly candles, to monthly candles. But for now, while we're here, let's try to identify a key level that could serve as a target for the decline and at the same time act as support. Let's select a horizontal ray. And what do we see here? Well, first of all, let's turn on the magnet. We can see a local level right here. Let's make it white for contrast. That's $311. Why? Because during the upward wave here, we had a bounce after which the price went even higher. Notice that there was some trading around this level, but you can't really say it was a key level, right? Yes, here we broke through it at this point with a gap. But you can't really say that the price movement stopped exactly at this level. Let's look for another one. Well, probably right here is the highest close. It looks much better. For what reason? Because there was a clearly defined reversal here with a new low. After that, look, we tested it for several days in a row, broke through, went far up, then fell back to it and went up again, tested it once more. This, you could say, is the target level for a decline based on the daily candles. And that's $288.14. I can't come up with anything smarter here. So either we return now to the level of $311, and that will be the decisive one, yes, in order to count on a higher rebound, possibly to test the level of $362. But overall, the situation points more toward a continued decline to the key support at $288. I have my own indicator that shows overbought and oversold conditions on different time frames. And here on the screen in front of you is a snapshot of the current state of the indicator on time frames from 1 hour to 1 week. So if you look from left to right, it goes 1 hour, hourly candles, 4 hour, 12 hour, daily, 3-day, and weekly. And you can see that on the 4-day candles, there is extreme oversold condition. With such an oversold condition, a corrective upward movement is very likely. Upward to where? Well, at least to the level of $311. This once again shows that shorting right now is a really bad idea, despite the fact that the probability of the downward movement continuing is quite high. Now let's take a look at the weekly candles. On the weekly candles, let's remove all the markings because they were built based on the daily chart. We see a fairly clear target, and that target is the 200-week moving average with the 300-week moving average right next to it. This is the range of $282, or rather $276, somewhere around there. And note that the RSI continues to point downward toward the 30 level, and it could go significantly lower. But I want to emphasize that due to the very strong oversold condition on the 4-hour chart, I definitely wouldn't open short positions right now. In other words, they should have been opened earlier. But if you don't like shorting, and that's completely understandable, since short positions are the riskiest, then it makes sense to simply wait for a deeper decline before considering buying, because there are still downside targets. That's if we look from the perspective of moving averages. If we look from the perspective of levels, here we have a reversal point. Notice there was an upward movement. I'll even zoom out the chart. Take a look. There was a long uptrend and then a rather deep correction. This level, you could say, was decisive for us. Why? Because right here we tested it, in this area we tested it, and in this area as well. And here at first we traded below it, then above it, but every time we kept hitting this level. $293.34. And the same 200-week moving average is also pointing right here. That's why we can most likely stop somewhere in this area after reaching the 200-week moving average. And after that, we'll see. Most likely a correction, unless it happens right now, because the 4-hour time frame is screaming, it wants to go up. Now let's look at the monthly candles after first removing all the markings. On the monthly candles, we see a powerful bearish engulfing pattern. If the month closes like this, and it almost certainly will since today is July 29th, meaning there are only a couple of days left in the month, this means that the movement is only just beginning. Its target level is, at the very least, this point right here, $290. Why? Because if you look here at the monthly candles, we had the first stop, a rebound, then we went lower to test the level, and even lower after that. Then we tested it again with a deep move down, followed by a strong breakout, a retest with a complex move downward, and now this level acts as a magnet. I would say that we are very likely to see $290. What's more important is what we'll see next. And next, most likely, we'll see a move toward the 100-month moving average. And at the same time, we can mark this as a level in this area. $208. Look at how precisely it hit this spot. And now finally, let's try to figure out what's happening on the 4-hour candles. First, I'd like to draw your attention to the fact that the RSI on the monthly candles hasn't even approached the 30 zone, which means the potential for a move toward the $208 area still remains. Let's remove all the markings and switch to the 4-hour candles. What do we see here? Here we see an extreme oversold condition on the RSI. What I showed you on my indicators is not RSI. It's absolutely not RSI and has nothing to do with RSI. But here, nevertheless, there is indeed an extreme oversold condition according to the RSI as well. And this suggests that we might see a rebound. And right now, it's obvious where this rebound could happen. Well, first of all, we're going to draw a Fibonacci retracement. And secondly, and let's start with the second point, this level here, meaning the key reversal point, we broke right through it, and now we might return to it. That's $339. Now let's stretch the Fibonacci retracement. Let's put the owl on the globe. And if we take it from here, well, that's about 23.6% retracement. But let's check our grid. It's not on the logarithmic scale, but now it is on the logarithmic scale. So a retracement to the area around $339, if it happens from the current levels, is roughly the 38.2% retracement zone according to the Fibonacci grid. I'm not claiming that the bounce will happen right now, but such extreme oversold conditions on the 4-hour chart suggest that the probability is very, very high. But overall, globally, the market is trending downward. Downward to where? I've already said. Subscribe to the channel and leave your comments. What do you think about the market? What do you think about the sound and the video quality? And the next review will be later today, and it will be dedicated to Bitcoin.